This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, I'll be giving you a portfolio update for the Sharesies public portfolio for the month of March as well as April. So last month, I didn't provide an update just because there wasn't actually any transactions that I've made in the portfolio. So I thought I'd skip that out and instead made the video about Air New Zealand, which I'm glad because that's got quite a few views on that video. If you've joined us from that video, welcome to the channel. Every month or so, I try to give you a portfolio update on my Sharesies public portfolio where I disclose all the positions that I hold, all the trades that I make, and I also track the performance of that portfolio on ShareSite so that you can see how the portfolio is performing against the benchmark NZX50. So if you're interested in that type of content, be sure to subscribe for more. As always, none of this is financial advice, purely for entertainment and educational purposes only. In today's video, I'll give you an update as well as talk about when you should be selling a stock, because in the month of April, I did actually sell a stock for a relatively large loss of about 62%. I'll show you and I'll talk about it a little bit later on after the update. So without further ado, let's get right into the video. So over here is the public portfolio closing at the end of April 30th. As you can see, the portfolio value is $23,105. And the positions are Heartland Group Holdings, Oceania Healthcare, the largest NZX position, but also the highest loss at the moment. We have Infertil at $3,178, Macquarie Group Limited, Collins Foods Limited, Auckland International Airport, and Centre Group. So overall, the performance is around 10.79%. And if you look at the chart, the portfolio has kind of stabilized over the past few months. As you can see, the gains were much higher. And as you know, with what's happening around the world, with the stock market being very volatile over the past few months, the portfolio gain has narrowed significantly. So let's take a look now at how the portfolio has performed against the benchmark NZX50. So over here I have ShareSite. ShareSite is a great tool for you to track your portfolio performance, and when it comes to tax time, it's very easy. So if you haven't already, check out ShareSite. I have a video detailing how to use ShareSite in more detail. You can check out in the link above. But if you sign up with a link down below, you get 4 months for free when you sign up with a 12-month plan, right? So take a look at that. And you can see here the portfolio, as I mentioned, has started to stabilize now. The portfolio was significantly outperforming, but then with Oceania Healthcare being the largest position and also dropping quite significantly over the past few months, the portfolio has normalized closer to the index performance. So over the past two and a half years, you could say, when the portfolio was started, I wouldn't have been much better off investing in individual stocks versus ETFs. I could have just put my money in ETFs and get roughly about the same performance as what I'm currently tracking. But at the end of the day, I do expect the portfolio performance to be relatively volatile in terms of market volatility, but hopefully over the long term we'll be able to outperform the market. So here is the performance annualized. It's about 9.71% versus the Smart Shares performance of 7.15% per annum. And as you can see, Kogan was the position that I did sell out, and I sold that out for about close to 62% of a loss. If I just show open positions, only ASX positions now, mostly in the green with one small red position, Oceania bringing down the NZX performance, and that leads to an overall performance on open positions of 10.34%. Now I'll show you a report over here which shows you all the trades that I have made over the past 2 months so that you know I'm not doing anything funny. I did recently sell out of Kogan, as mentioned over here. I did sell out at $4.01. Currently, Kogan is trading at $3.91. So it did report a very bad trading update where we saw the shares tanked quite significantly. Reason for that being that overall sales had moderated in the first 3 months of the year, falling 3.8% to 262 million. So for Kogan to be priced as a growth stock, it needs to be continuing growing going forward into the future. But currently with what's happening around the world, potentially demand destruction because of higher inflation, that's led to a lot of retailers actually posting moderate or slow growth or even negative growth over the past few trading quarters. And in terms of Kogan, the reason why I actually did sell wasn't because the share price dropped by 11% on the back of this trading update. It was because the fundamental thesis of why I held Kogan in the first place had been broken. So in my mind, when I bought Kogan, this was just, I think, around during the Delta crisis in Australia. People were going back into lockdown. And when people went back into lockdown, I thought Kogan, being an online discount retailer, was able to take advantage of stay-at-home orders. People don't have much to do. They'll buy stuff from Kogan to fill in their time, as well as that the company had a significant inventory balance. They over-ordered in the initial wave of COVID, and as a result of that, I thought they could take advantage by being able to, sell lots of product while other competitors had supply chain issues. Unfortunately, this case didn't turn out. To sell off their inventory, they needed to get rid of them quickly by having lots of discounts, so margins fell, and as you can see now, sales is also falling. So this is like a double whammy, and in my mind, it will take quite a while for this ship to turn around. And so the fundamental thesis of why I held Kogan in the first place didn't hold up. And the reason why I didn't sell earlier, I realized the 62% loss, was because I thought I could get out when there was a rebound in the share price, with the price just going down a cliff, as you can see over here. If I go back 1 year, it just went down and down and down. Sure, there were times where I could have sold out, but unfortunately, I wasn't a very good market timer. So at the end of the day, I just sold out at about 401. I'm not sure how this will turn out after all, but the reason why I sold was a change in fundamental thesis. And the second reason why I did sell is because of opportunity cost. Right now, the markets are melting down and there's a lot of good opportunities out in the market. So if I take a look at the NZX 50 index, you can see year to date, we are down 9.63% over the past year. The index has really gone nowhere. It's downtrended about close to 7%. So we're in a market where there's lots of volatility and there's also opportunities now presenting itself. And with the portfolio, you can see that I don't have much cash overall. The portfolio value is $23,000, including cash of $1,100. So if you think about that, that's less than 5% of the portfolio. So in order to buy new positions, I will need to sell some other positions. So the way I look for opportunities out there is to look at what's been sold down significantly. Usually I would go through the top 10 and then top 20, expanding that universe. So if we look at just what's happening in the top 10 or top 20, you can see that over the past year-to-date performance of these stocks, you can see that some of them have been sold down quite crazily. So I've talked about Fisher & Paykel Healthcare on this channel before. I've made videos on them in the past, and you can see that they're actually the worst performer year-to-date in the large cap space. So Fisher & Paykel with an $8.12 billion market cap. I think that's in US dollars. So in New Zealand dollars, it's about 12 billion. Fisher & Paykel shares are down 35%, close to that. And Ryman Healthcare, another aged care and retirement village operator, is also down 28%. So I'll probably be making a video on Ryman Healthcare this month. I have done some more research on Ryman Healthcare, so I'll be talking about that later on in this month. So if you're interested, be sure to subscribe for more content on that. We also have Fletcher Building and A2 Milk also being one of the worst performers year to date. Now, I do want to caution you that just by filtering by the worst performer on the list doesn't make it a good buy, right? Just because a stock has fallen significantly doesn't mean it's a good buy. Like Kogan did drop significantly before I bought it. It peaked at $24.75. I bought at about $10.63, and now it's trading at $3.91. So just because a share has dropped significantly doesn't mean it's a good buy. And I'm not showing you this to give you advice or anything to buy these shares that have dropped significantly, but rather make this a filter that you could use to find potentially undervalued stocks, where you go into more detail on the underlying businesses and how it could potentially play out in the future. So for example, Fisher & Paykel Healthcare is a stock that I've done a deep dive on this channel before. If you're interested, you can check out that video over here. So I'll be looking into more detail and seeing whether any of these are good opportunities out there. But I do expect to make an investment move in May, given that the portfolio now has some level of cash at the moment. It'll be interesting to see where this goes. But to recap, 2 reasons why you should sell a stock. First is your fundamental thesis has changed because of something happening within the business, or it could also be a macroeconomic event that has changed the business, like for example airlines and COVID-19. Another reason why you could potentially sell is opportunity cost. As I said before, this portfolio doesn't have much cash available. It is fully invested. When there's better opportunities out there, then I would potentially look at what stocks have the lowest upside, sell those stocks, and reinvest them into somewhere else. So those are the 2 reasons that you should sell a stock. Hopefully you found this helpful, given that the market has been melting down. A lot of new opportunities will be showing up. And so it is a good thing, I think, to reassess your portfolio, see what you have conviction in, see what you don't have conviction in, and recycle that capital and hopefully make greater returns doing so. So that's all for today's video. Hopefully you guys enjoyed it. If you did, be sure to hit like and subscribe. Thank you all for watching. Until next time, take care.